Mhm, mhm, mhm. User quadruple 087. Or is that quintuple? Hi, welcome to the live. I'm fully welcome. Welcome, welcome, welcome. Tanaski, Temba, welcome to the live. We'll be starting in about 5 minutes or so. I want to give people time to get here. Shali, welcome to the live. Saith Sab, welcome. X, welcome. Lebsatu, hi, welcome. Vuyo, welcome to the live. We typically begin 11 p.m. Mondays through Fridays. Mondays are for charts, and Fridays are for psychology. If you're a complete beginner, you may find some of the stuff I say confusing, so I'll advise you to check out stuff on sites like babypips.com. Who's all in here? Bright Owens, welcome to the live. Hey, Freddie, welcome to the live. Thank you, Freddie. Udogu Billions. No. Luazi, hi. Umpole, thank you for liking. Hey, Patty, good to see you again. Umpole, thank you for the likes. Patty, thank you for the likes. Freddie Black, oh, you are so kind. My number one. Vuyo, thank you so much as well. I see you. Patty, I see you. Hey, Freddie, man, much love to you too. How's everybody doing? How has your trading been? Any challenges? Any profits? Any losses? Share, share, share. I'm curious. Hey, Kaya Alvin, welcome to the live. Bright Amanor, welcome to the live. Les Dunamis, nice to see you again. Hey, Freddie, you're awesome too. Thank you so much. I appreciate you. Freddie, it's like you made some good money today, huh? Hello, my Dala. Hello, hello, hello. Hi, Benny J. Welcome to the live. So we'll be starting in 4 minutes. I just want to give people time to get here. Okay, Alvin. Okay, Alvin, why are you crying? Don't worry, I'll make the liquidity concept simple. And I come here Mondays through Thursdays to talk about that. On Friday, I don't touch the charts. Today's price action is interesting, though. Depending on what you're trading, lots of chops. Chopping back and forth. Starting in about 3 minutes. Kaya, why are you crying about liquidity? ICT has shown everybody shaky. Bah. Thank you for the likes, guys. This just gives people time. Though I'm actually itching to get started. I'm itching to get started. No, I can't use this chart. I have some important notations on there, so I'm going to skip that. Wes Dunanis, I see you. Thank you. Freddie, thank you so much. Olati, hi, welcome to the live. Nice to see you again. It's always nice to see you guys return. That's the fun part for me. Your USD on a bullish trend. I actually didn't trade today. I just literally opened my charts this night. But yeah, it was bullish. We came off of last month's low. That much I remember. Good evening, Olati. Nice to see you. Nice to see you. Oh man, it's cold though. For office Isisha. James F. Ferry, welcome to the live. Listeners, thank you for the likes. I see you. We're starting in exactly 1 minute. What's my favorite currency pair? Pound CAD. Pound CAD, seconded by Euro Aussie. No, Euro dollar actually. So I like euro dollar because of the spread. The third one would be Aussie dollar. I like Aussie dollar because she's a little bit slow, which is nice for when I'm not in the mood to be all over the place. Very nice for scalping. Euro dollar, same reason I like it because it's very nice for scalping tight spreads. Pound CAD because it moves too much every day to not be able to get at least 5 pips. And when I first started chatting with you guys, actually, I wasn't chatting with you guys then, my rooms were very empty. But when I first started posting, you noticed that I kept talking about taking just 5 pips per trade with a stupidly wide stop loss. I am not preaching that here. Please don't try that at home. Yusufa, it's nice to see you again. Ready to get the refilling. For sure, for sure, for sure. All right, it is time. So let's get started. I'm going to flip my camera around. You guys ask any questions or anything in the comments. I will not be able to see until I'm done. As you know, per usual, I will get distracted otherwise, so I have to ignore it. So anybody gifting or anything, know that I appreciate you. It is not that I am an ingrate, it's that I didn't notice, okay? And typically when I'm done with my lives, I don't go back to review. I just go do other stuff because I'm actually just here to teach. Any gifts you offer me, I appreciate deeply, but that's not my purpose here. Not to say you shouldn't send, please, absolutely, have fun. But if I don't say thank you, you know why. Okay? But when I do see, I definitely will appreciate you as it pops up on the screen. All right, let's move. I'm gonna flip my camera around and adjust the brightness on this thing so everyone has a good view. All right, good. Let's see if I can. This was so much clearer the first time I went live, but this will do. Okay, everyone. Good evening, ladies and gentlemen. My name is Nessa, also called I Take Ticks on TikTok. This is my only account. Anyone else who is pretending to be me is, well, definitely not me. And my thing here is that I teach you how to simplify the trading concepts that I have learned over the past 10 years. I spent 9 years unprofitable, and then finally things began to click for me in the 10th year, and I promised myself that what I would do is come here and share what I know, simplify it, make it as stupid simple as possible so that people can understand. Because one of the things that I struggled with was I had too much information, and that was very confusing. So, those of you who are familiar with what I'm about to share, you already know this. The person that I have learned from is the Inner Circle Trader, who is also called Michael Huddleston or ICT. Not that I learned from him directly. The point is I studied his concepts. And what I would come to find is that I thought I needed to know everything. I thought I needed to know every single thing the man taught. But what it did to me is it made me very confused and made me see reasons to be a buyer and a seller all the time. And of course, that messed me up terribly. So now that I'm here, my motto is simplicity. Anytime anyone's touting anything, like in the Telegram group, which by the way, the link is in the bio, someone's touting something different from what I share, I'm very quick to put it down and eliminate it, because I remember that back then in those days, I would be in trading groups and people are talking about all kinds of strategies. And it made it very hard to just focus on one. And I promise you that you do not need too much. So what I'm going to teach you today is liquidity. And liquidity is not a strategy per se. It is a story about price, a story that you can use for your strategy, whatever it is. I will show you how to get in and how to get out. But ultimately, if you don't want to get in and get out with the ways I show you and you want to stick to your strategy, that is fine. But the thing about liquidity is it will show you when you are right about a trade and when you are wrong. And it gives you, the way I teach about ranges, and it gives you a framework for understanding where you are in the market, when to stay out and when to get in. All right, so all of that preamble aside, let's talk about what it is we're here to do today. We're going to talk about, hang on, let me pull up my text tool here, per usual, and make that wide. And by the way, while I have you here, those of you who have been listening to me for a while and you're still struggling, I want to ask you to do me and actually yourself one huge favor. I need you to pick one thing. I need you to pick one pair. Excuse me, this is going to move around for a bit. I have to turn off my AC. All right, there we go. I need you to pick one pair. I need you to just pick one thing. I need you to stop hopping around. I need you to be okay with the fact that there's going to be movement on every other pair every day, that there's up to 20 something, if not over 30 something pairs that you could trade at any single point in time, but that doesn't mean you have to be in everything. So if you are having trouble, you keep giving back your profits or everything, I promise you, if you just pick one pair or two maximum, those of you who are already familiar with what I'm about to teach, create your ranges around those two and realize you don't have to be in a trade every day. You don't have to. If you decide you're only going to trade 2 or 3 days a week and you've only picked two pairs, I promise you your results will be phenomenal. Okay? And also it helps you focus so you're not scattered all over the place. But for me personally, my two pairs are GBP CAD because it moves around a lot, and Euro USD because it has a tight spread so I can get in for really quick scalps. Sometimes you'll see me touch other pairs, but those two, they're the first things I always look at. Okay? So let's talk about today's topic, which is liquidity. Whenever you see or hear the word liquidity, I don't want you to think it's some huge concept that only the finance bros could ever understand. It's not, right? Let's see if I can make this clearer. Give me a second here. Give me a moment. It's a little fuzzy and I'm trying to understand why. Alright. Come on now, don't piss me off. You don't want to piss me off, do you? Of course not. Okay, so I'm going to make this larger as well. Let's make that 18. See if that helps. Every time we talk about liquidity, I don't want you to feel intimidated because it's quite simply money. Whenever you hear the word liquidity, it's money. You hear this a lot when it comes to the ICT traders, those who trade based on the principles taught by Michael Huddleston. And I need you to understand this thing, it's not a strategy. It's a story about money. Everything he teaches, you'll notice that it's like a lot, but really he's just teaching you different approaches to use the same story. Okay? So why is liquidity important? Why does it matter? It's what you're about. When you come to the charts, you have to know the answers to these three questions. Number one, where is the money coming from? Okay. Number two, where is the money going to? Number three, is there enough room between these two places to take some for myself? Now, if you'll excuse me, I'm going to take exactly 1 minute and I'll be right back. Just hold on a second. I need to sort this out. Okay, let's see if this helps. All right, I think that is much better. Not great, but better. So, why do we have to ask these three questions? Because it's the whole point. That's why you're here. Every time you open up your charts, you need to know where the money's coming from. You need to know where the money's going to, and if there's enough room between these two places to take some for yourself. And the only way for you to know that for sure is to create your range or find your range. Find your range. You'll learn what I mean about that shortly. See, if you come to the chart and you can't answer these three questions and you just jump into a trade willy-nilly, number one, you'll have no idea if your entry is solid. This is why those of you who struggle with constantly, you come into a trade, you're buying, next second the market pulls back just a little bit and it's only a pullback, but you interpret that as a reversal. Now you're confused, so you close the trade and then you try to sell again, and now you're selling and you can see the market's pulling back up and now you're buying. You see that constant fluctuation between buying, selling, that is because you have no idea where you're coming from in the first place, let alone where you're going to. Why is where you're going to just as important? Because if you do not know where you are going, you will not know when you should have put or you should have taken your profits or where you should place your take profit. And then what happens is you find that you are in profits. You're excited. You're feeling good about it. Your greed starts to kick in because you've made no plans for exits. See, people are always so particular about their entries, but never their exits. And that's fascinating to me. If you have no plans for your exits, then guess what? So you have all this money and it's floating and it's great and you're doing well, you're about to pass your challenge or you're thinking about how you're going to withdraw from your personal account. Next thing you know, the market starts to turn around. And then you keep telling yourself, oh, it's only a pullback, it's only a pullback, it's only a pullback until it pulls all the way back, not just to your entry, but to your stop loss. That's why you must know where the money is going to. Now, the third question, is there enough room between these two places for you to take some for yourself? And the only way to answer that one is to find or create your range. Still, same thing. So what exactly is a range? You've heard people talk about your daily range, weekly range, monthly range. You've heard them talk about the Asian session, London session, and New York session ranges. But I find this to be unnecessarily confusing. So this is my very simple definition of a range. It is the distance or the area between two price points. That is all it is. Very simply, a range is the area between two price points, which means I'm going to grab my horizontal lines as usual. Those of you who are familiar, you know this part. If we have this line here and this line here, right? Let me zoom in a little bit. So this space between these two lines is a range, even if it looks very tight. Even if it's only 1 pip, this is a monthly chart, by the way, so that's not going to be so clear. So it's going to be a lot more actually. But let's say it was only 1 pip between these two lines. That 1 pip area, that counts as a range. But obviously, as a trader, you're not looking to trade 1 pip ranges. Okay? You're not looking for that. You're looking for something, once more, that has enough room for you to take some pips for yourself. So how do you define your ranges? All right. If a range is the area between two price points, then it means I could very simply look at this last month's bar. This is Euro USD on the monthly chart. Hang on a second. I'm trying to see if I can make this clear. I don't like it. There's a bit of blur today, and I'm trying to understand why. Okay, so this is Euro USD on the monthly chart. This red bar here is last month's range from high to low. So I could very easily say for my range, I'm going to mark the area from the high to the low. And that will be my range. So this here and this point here. Some people use opens and closes, and that's fine if you want to. I don't. I have not. And so that'll be like completely your experiment to deal with. Okay? Give me a second. I'm trying to adjust this. TikTok is fucking with me today, guys. It is messing with me. Oh well, I'm going to trust you can see. So we can use a single candlestick to define a range. Even if I go down to the 5-minute chart, this is the 5-minute chart now, I'm going to delete this, and I were to pick a single candle here. Oh, it's just 5 minutes, it's just 5 minutes, I don't care. As long as that candlestick has a high and a low, to me that counts as a range. Each of these candlesticks, any one of them can be used as a range. But of course, you want to be strategic about picking your ranges because what did I say in the first place? There was this thing about there being enough room for you to take some for yourself. And so what this implies is very simply, you want to use a high time frame or a high range frame to mark your ranges. So let me type that out. All right. For you to have enough room to take some pips for yourself, you need to use a high time frame or a high range frame. So this begs the question, okay, Nasa, what do you mean by high time frame? What do you mean by high range frame? Great, I'll get to it. So for me, as far as I'm concerned, the high time frame is anything from your 4 hour to your daily, your 3 day chart, your weekly, your monthly. All right, this is a 4 hour chart. Why does that matter? Why does it matter? For those of you who are still kind of new to trading, but you still understand this portion of what I'm talking about. This is a 4 hour chart. Let's look at what this single candlestick measures, right? Let's see how many pips is in this single candlestick. So from the low here all the way to the top side, what I see on my chart is 165 pips. This is Euro USD. Now what I'm going to do is I'll drop down to the 1 minute chart and I'll look for a candle that looks just as dramatic. Hell, you know what? I'm actually going to use all of these three. Let's see. From here to here, do you know what this is? It's just 5 pips. 5.6. That's all it is. So that is largely inadequate. It's not adequate. Unless you are a scalper, you're looking to take just 2 pips or 3 pips or something, this is not the best idea to use for a range. So that's why you want to go to higher time frames. Higher time frames are from H4 and upward. Or if you're trading something that's more volatile like GBP CAD, and by volatile I mean it moves a lot of pips every day, usually, regardless of whether there's a news event or not. If you want to use GBP CAD, then H1, the hourly chart, would also count, right? So let's take a quick look at, I'm going to ignore all of this because this is not a typical, this is Euro USD, and it is not typical for Euro USD to move 300 and something pips. Typically, that's not the way it is. It doesn't move that much. So this was the whole of last week, 300 and something pips. The week before that, as you can see here, not as much movement, just 160 or 170. This is the week before that as well, 151. So now I'm going to take you to GBP CAD. Those of you who are struggling to take anything at all, you may want to try GBP CAD or GBP XXX pairs. So specifically GBP CAD, GBP AUD, GBP JPY, GBP, what else? NZD, EuroCAD and Euro Aussie as well. The reason I'm mentioning these pairs is because they move so much every day that it is impossible for you to not get something for yourself. So now we're looking at GBP CAD on the H4 chart, and let's look at the entire price action for last week. So this is actually not as much as Euro USD. Euro USD last week was an anomaly, but this is 220 pips. This is also an anomaly. But typically, this is the stuff you get. Let me zoom out so you can see much better. Stuff like this. This is 381 pips. Stuff like this. This is 200 and something. So you can't tell me in a single week you can't get something, right? This is why I advocate looking for very volatile pairs. Just a caveat, please. You'll have your stop loss, a generous stop loss, because the thing about these pairs that move a lot is they can very easily pull back. A pullback could be 50 pips. All right, where on a regular pair of pullback could be just like, maybe 20 something. For GBP XXX pairs, it can be very dramatic. Go and check it out for yourself though. So let's come back to what we're talking about here, taking us back to Euro USD where my notes are on the monthly. All right, let's zoom out, and I need to get rid of these period separators if you will indulge me. Yeah. Okay, so how do we define our ranges? We said you need to use a high time frame, and I've explained what a high time frame is. But what the heck do I mean by a high range frame? So those of you who are already familiar, you know where I'm going to with this. By high range frame, I'm referring to working with charts that do not work with time. So for instance, we have two kinds. We have the Renko chart, and I'm going to show you what that is right now. Just give me a moment. Let's take you to a 20 pip Renko bar chart. This is a Renko bar chart, okay? And if you don't already know what it is, I'll explain. The whole idea is while the regular charts you have on your MT4, MT5, and what else, they work like maybe if it's a 15-minute chart, each bar would be created every 15 minutes. A Renko bar chart does not care about time. So if it takes, this is a 20 pip Renko bar chart, which means each bar is worth 20 pips. So if it takes the market 25 years to move 20 pips, then it will take 25 years before you see this break form and close here, okay? And as I always explain to you, don't be deceived by how clean it's looking, because just because the market closed here and then opened here does not mean there was not a bit of a pullback to the downside. It could have pulled back as far as almost down here at 19.9 pips before turning around and then giving you a close up here. Same thing with this, with the bearish one. Just because you see the close here does not mean the market did not push a little bit down. It's just that the Renko charts do not show you wicks. So they focus strictly on the opens and closes, okay? Now, the other kind of chart in terms of price that only honors price instead of time is called a range bar chart. So I'll take you to a 20 pip range bar chart, and that's what you're looking at now. So the reason that I love these is because I'm used to finding specifics, the specific things that I look for with a range bar chart, for instance. It's things like, let me show you one here. I can't really find it here. Give me a second. Let me drop down to a 10. See if I can find stuff like that. But basically it operates in the same way as your Renko, but the difference is you'll see these wicks here, and these wicks can be very informative. It can be very, very informative, and I'll show you something later that I'll show you something on GBP USD to explain what I mean by that. But basically, each of these is worth, this particular one is worth 10 pips, 10 pips, 10 pips, and it's the same concept. When the price has actually put in a low, until the market pushes from that low upwards by 10 pips, you won't have a closed brick. So the advantage of this is it cleans up the price action, all right? It makes it look a lot less untidy than, this is M15. Look at this. How do you, I can see how to trade this in a sense, but notice how it just doesn't look nice at all, right? It just doesn't look nice at all. So when I say, let's come back to this again, high range frame, I mean that you want to use something like, for instance, the 50 pip range bar chart. Why is that? Because notice how all of a sudden, all of this is just clean moves. What I'm going to do is I'm going to mark this off because I need you to see it. So it's not like I'm just talking about it. Let's change the color here, switch this to white, and then make that transparent. And so what I'm going to do is just mark off all of this from here to here. And then I'll take us down to, let's say the 1 hour chart. And look at the difference between that and this. All right? Just very clean. That's why I like it. So now that we've talked about that, I said you need to use a high range frame. Why? Because the question is, you don't see it here, but let me show you. Let's talk about it. So let's look at this particular bar over here. We notice the market has been pushing to the upside. So it's pushed up from this point here all the way to this point here for 195 pips. Almost no drawdown at all. Like very little pullback, I mean. And now we have this bar here. Notice how immediately, if I'm focusing all of my trading around this area, it becomes easy for me. How? It basically means if I notice, and this is just an example, by the way, one way of which you could trade with a range. It means once this has closed here, if I'm looking to continue buying, I would have to wait for some sort of pullback on a regular time frame before I hop in for a buy. Or if for whatever reason I thought it might be a good time to sell, then I know that whatever signs I'm looking for to sell, and this is not exactly what I'm going to teach you, but it's just an example of a way you can apply this, is whatever I'm looking for to sell, I want to be able to take enough for myself. So if the market is closed here, whatever is happening, I want to be looking for my sells inside the box and then looking to take it out. This is the end and the beginning of everything that I've been teaching you. It's just, I keep saying pick one, pick one. I think that where people probably feel confused is like they have to do both things. You have to, because the other thing I was teaching was, it's either you are inside here looking for something inside here to buy from the bottom to the upside if you think it's going up, or looking for something to sell from the top side down if you think it's going down. That's thing number one. Thing number two I was teaching was you wait for the market to come out first and then look to take that back in. Okay? I think that's where people are getting confused. Or you look for it to come out. In this case, it came here. And then look to trade that back in. You don't need to do these two things. I keep saying you have to pick just one. And picking just one doesn't mean that you will always be right, but it does mean that you will be right more often than you're wrong. It does mean that you will make profits more than you lose. All right? So let's look at this one as well. Before I start going granular about liquidity and all of that, Look at this one. This bar closes here. And if you wanted to be the kind of trader that looks for something in here for a reason to be a buyer and then take that outside, you could have. If you wanted to say, I'm going to wait for a pullback to the 50, so this didn't come to the 50% area of this, but if you wanted to, you could have. It just means you wouldn't have gotten any trade. Or if you just use this bar and say to yourself, you know what? As long as we do not break the low of this bar, I'm going to keep looking for reasons to be a buyer. That could be more than enough. You don't need to learn any of the other stuff I'm going to teach you. If you just say, okay, I notice this is bullish. It is 50 pips. I am going to look within these 50 pips for some reason to keep buying, or even beyond this 50 pips for a reason to keep buying. And I will tell myself that if the market pulls back to this low here, then I know that I'm wrong about my buys. That's one way to view it. That's one way. Another way to view it is someone else is thinking, no, actually, I want to be a buyer at the lows. Let's see. It doesn't matter. I need you to understand something about strategies in general. The thing about a strategy is ultimately it is just an excuse for you to engage with the chart. Do you know why? Let me tell you a simple truth. There is not one person on this planet who knows exactly what the market is going to do at every turn. What we make are approximations. You are in the business of probability. There is no strategy that will win 100% of the time. Losses are part of the game. But a lot of you have not made peace with that idea. And I understand it because it's your money. Nobody wants to, generally a normal person doesn't want to enter a business and the first thing you're being told is, yeah, you might lose money. Generally speaking, but you have to accept that. The minute you accept that is when you stop doing those things where you keep flipping between buying and selling and buying and selling and buying and selling. And what I'm showing you with the concept of a range is to keep your life simple. So now you have this box here. Let's talk about how all of this ties into what we were talking about in the first place, which is the idea about liquidity. So let me find my notes, see if I can drag them. Yeah, I need to go back to the monthly chart for this. Just drag my notes as close as possible. And let's take us back to that 50 pip range. Is it close? All right. So now you know. I've shown you how to define using a high time frame or a high range frame. No. Come back. I've shown you what I count as a high time frame. And I've shown you what a high range frame is. All right? High, 50 pips. Any range, if you're using a Renko bar, if you're using a range bar chart, those are high enough. Now, it can be relative. What do I mean by that? If you are a scalper, 50 pips may be a little too much for you. You may want something a little lower. If you are a day trader, 50 pips is decent. If you're a position trader, you may want to use 100 pips. This is relative, and there's only one way to find out, which is you must go to your charts yourself and study for yourself. I can tell you what my favorite pairs are, but that will not help you because you don't know exactly why I like them. You don't know how I use them. This is something you'll have to do for yourself, okay? Things can be relative. For a scalper, the 15-minute time frame can be their high time frame, believe it or not. It can be. So you have to figure out what kind of trader you are. If you are still stuck, I'm pretty sure, not 100% sure, but pretty sure that part of that is because you have not decided this is who you are when it comes to trading. Because once you decide, it makes it easy for you to ignore anything that does not look like or smell like or act like your setup. And that is the attitude you need to be a complete and utter snob when it comes to trading. It's like you want to get your dream car. You would not settle for crap. You can't save all that money after all those years. You're finally ready to buy a car, and now you're going to settle for nonsense? It doesn't make sense. You wouldn't do that. Same thing when you're making big purchases like a house. You wouldn't save and save so much just to go buy something that's going to collapse on you the next day. So why can't you be just as selective with your trading? Even if it means that some days you will not find a setup. It's okay. It's okay. It means you get to keep your money. You get to trade another day. So let's come to how to define these ranges, right? Method number one. we can use a single bar. What do I mean by a single bar? I'm talking about whether it's your candlestick, your Renko bar, your range bar, it doesn't matter. So let me go to the 4-hour chart again and show you. All right. You could very well pick the high or the low and high of this right here and count that as a range. This is a 4-hour chart on Euro USD once more. You could pick this guy over here and make this your range. I don't care. You could pick anything. As long as it's a closed candle, you can pick that as your range. All right? That's one option. Even if it's the 1 hour, it's the daily, I don't care. You can pick that as your range. And for the daily chart, let me show you something. So this is this entire day. I'm going to ignore that because that's not typical for Euro USD. But I'm going to pick this guy here. So pretending that all of this other stuff has not happened. So let's go down to the actual day that you selected. So bear in mind all of this, and I'm bringing back my period separator so there's no confusion there. Everything you're looking at here that we've selected, this is all of this day's price action, like so. But it was a single bar on the daily chart. So it depends on you, all right? And you could, this is a 15-minute chart, but you could easily pick one bar as well and make that your range. It doesn't matter, honestly. You could go to your Renko chart. Let me pick, where is it? 10 pip Renko chart. It's loading. Give it some time because it's a Renko. It needs to populate. We're waiting. Sometime yesterday, please. Thank you. Right. No, please take your time. There we go. You could pick one bar. Okay? Look at this right now. This is where we are. You could pick this one bar here. Excuse me while I change this. And I'm about to say something I didn't say before. I don't think I've said before, but it kind of is like a common sense thing to me anyway. You could pick this one bar. It's a closed bar. That is your range from the high to the low. And then you know, okay, your playing ground is somewhere within this. Or you could say to yourself, well, whatever I'm going to do on the charts doesn't matter to me as long as this low is not broken. That's one way to approach it. Or another way to approach it would be, you know what, I'm going to wait until the market actually breaks it, and then I will look to be a buyer or be it totally depends. So this is one thing you can do. Another thing you notice is, what do we have? You know already what this represents as consolidation. The market pushes down, pushes up. It's been unable to close beyond these points here. So guess what I can do? I can stretch this and say, yeah, this is the entirety of my range from this point here to this point here. So technically, I don't have to bring it this far back. Technically, I'm using 2 bars. And you can do the same thing with a candlestick chart as well, if you wanted to. It's just that this would be much cleaner. Let's go to a range bar chart. We've already talked about it. You pick a single bar, and that could be your range, right? I don't know if I have the patience for this guy to load again. I don't know why it's taking so much time today. So basically, here you go again. Pick one bar, the most recent bar. This one is still in progress. This one, it's still in progress. So this guy here, this high, this low. All right, cool. Now I have a range. So let's talk about the second way to create a range, which is basically number 2, from swing to swing. And for me to explain what a swing is, some of you have heard ICT talk about intermediate swing high, intermediate swing low. I'll be very honest with you. I've forgotten what all of that is about on purpose because I don't need the confusion. So what is a swing? Let's talk about what a swing is. A swing is the turning point in price. What do I mean by turning point? It's simple. The market has been pushing in one direction, then suddenly it starts to push in the other direction. Where it starts to turn from, that's your swing. So look here. We're back on the monthly chart. Look at this. The market's been dropping down, dropping, and suddenly it starts to push back up again. This is the turning point. That's our swing. But really, actually, how do you identify a swing? It's a 3-candle pattern, okay? So you have a swing low and you have a swing high. A swing low is basically your bullish swing. That doesn't mean you should buy every swing low that forms, but it does mean it has the potential to be bullish. Now, for a swing low, you're looking for 3 candles. The middle candle will have the lowest low of all the 3 candles. The one to the left and the one to the right, they'll have higher lows compared to the middle one. For a swing high, the reverse is the case. You have this high here, you have 2 lower highs on either side for each candle. That is your swing. Notice how, yes, you do have a swing here, but it didn't turn around, did it? That's why I said you can't go around buying every swing low and selling every swing high. It needs to be with context. You need to understand why this swing is more likely to play out than this swing. And it's because of a little thing that I'm going to show you later on, but I can mark it for those of you who already know what it is. Right here, let's change the color. It's called an order block. We'll talk about it soon, don't worry. But here. All right? We'll talk about that later. So let's talk about more swings. This is another swing here. This is another swing here. And just because we have criteria for which swing should play out more likely than others, that does not mean that the criteria will work all the time. I need you to know. I, Nessa, will never tell you that something works all of the time. If I do, it's not me. I've been abducted by aliens. Send help. There is no such thing as a strategy that works all of the time. Anyone telling you that is looking to steal your money. I'm here to disappoint you and disillusion you really quickly. If you came to Forex thinking there is some holy grail strategy, it does not exist. I know, because I spent 10 years looking for it. I am quite the perfectionist, and I have a very obsessive kind of behavior. So I know I've looked. It's not there. It doesn't exist. Anybody trying to tell you it does, trying to sell you a system that never loses, they're lying. Please run. Okay? So let's go back to what we're talking about. If a swing is a turning point in price, how do you use a swing to determine a range? Well, it's very simple. I'm going to drag this off to the side and come here. So what are you looking at right now? You're looking at, let me delete this for a second. You're looking at Euro USD on the monthly chart. So what do we have here? First, the market pushed up and created this swing, 1, 2, 3. I need you to remember this is a monthly chart, so a monthly swing is going to be hella significant. The push that came after the swing was worth about 300 and something pips, 350. So again, monthly chart is going to be significant, okay? But when you notice that you have this high, now you want to start paying attention. What's the possible low that is going to form? When is it going to form that low? You don't know yet. You only know officially when what? 1, 2, 3. The swing low has formed. So now for me to mark my swing, all I'm doing is taking it from a high. Let me change this color again. Changing color, make it light, make it white, and make it a little less. Yeah. So from this high up here and this low down here, pulling that back. So what have I done? All of this stuff, mind you, hasn't happened yet. So I just know I have this high and I have this low. And the entirety of this space here becomes my range. Now I have something to play with. Okay? Look here. I want to show you an example of this thing failing because I need you to understand that sometimes it will. So we have a high here. It didn't even entirely fail depending on what you were gunning for, but I'll explain. We have a swing high here. Then the market pushes down. It created this swing low, but the swing low did not show you further signs of wanting to go up, did it? In this case, we had this swing low here, which in the third candle showed you that tendency to want to push to the upside, and later on continued. Remember, this is a monthly chart, which means that before any of these close, you have a lot of time to be studying this to know for yourself. So now if we have this swing high, and then we have the swing low, I'm just going to adjust this over here and pull that back. So now I know that I have all of this space. Excuse me, let me adjust this so it's better. I have all of this space to play with, which answers our question, is there enough room for me to take something for myself? This is a monthly chart. Hell yes. Same premise, even if you go down to a 4-hour chart, it does not matter. Same premise, even if you're trading stocks, Amazon, I don't care. It's the same thing. Look here. You have this swing. Why is it a swing? 1, 2, 3. Okay, where's the proof that it was planning to push up? Well, duh. This whole bar here, that's a lot. All right, then what do we have? 1, 2, 3. How do we know it's going to push down? Well, over the next series of candles. Okay, great. Now we have a confirmed range from this point to this point here. Now we have something to play with. So now if the market comes 50% of the way, we have something to take for ourselves. Or if we were looking to sell, maybe we've noticed the swing and then we notice a subsequent push to the downside, we could say, okay, there must be something we could take for ourselves to the downside as well. Make sense? Let me pull back out again. Let's look for more examples. Oof, changeover, I guess. Yeah. Look here. We have this high. We have this high here. And then what? Why is it a high? 1, 2, 3, swing formation. What happens next when this high is formed? What happens? 1, 2, 3, we have a low, but we don't know yet if it's going to go our way. But then what happens? It gets broken. No problem. That's life. Move on. If it's starting to get broken, all I'm doing is asking myself, okay, so here's a situation. This was a low and this was a high. You got demolished. Okay, great. Well, now what do? I have a couple of options. Number one is I could say to myself, let me look left for a lower low than that. And what do I have here? This. So I stretch it, and now that's the range I have to work with. Option two is I could say to myself, okay, so this guy got broken. No problem. I'm just going to wait for the next swing. Okay, I've got that here. Now I'm going to drag this down to the bottom here. So again, swing high, swing low. So now that this is formed, I have room here to figure out what I want to do. And if I'm trying to be a seller, this is why we talk about that whole thing about we're coming to it now. Don't worry, we're coming to it very soon, actually. We now have room in here. Why is this flipping around? Stop that, my friend. We have room in here to say, okay, there's something we could do. Maybe there's not a lot of room to the upside, but there's definitely a lot of room to the downside. Maybe if the market wants to give me a shot, maybe I could find something on a lower time frame and look to sell. Or maybe I don't need to go down to a lower time frame. I'm just going to be like, I see we're really close to this top here. See, I'm telling you this in story form for a reason. We'll get to the technicals later, but listen, I see we're close to the stop here. So if I say to myself, let me have my stop loss all the way down here and my take profit here. Those of you that don't do negative risk reward ratios, you see that it doesn't make sense for you. This is 60 something pips. This is 26 pips. So what makes more sense? For those of you who do positive risk reward ratios, what makes more sense? Is it not to say, okay, so I see we've made the swing and now we've pushed up here. I'm really, really close to the high of this range. Perhaps it would be better for me to have my stop loss above and then look to take something on the way or down there, because if this is 26 pips here and then it's dropping, you have about this room here to navigate. Let's say you don't want to wait all the way to the end because you don't know if it's going to push all the way to the end. It makes more sense. You have up to 52 pips. Okay, that's how you start to think about ranges. This is me teaching you, those of you who've been here before, you know we normally talk about liquidity. We're going to get into that, but this is just a way to think about it. That question, is there enough room to take some for myself? It's very, very important. Same deal here. What do you have? Excuse me while I zoom in. The market plummets and then starts to pause around here. In the pausing, what is the form? 1, 2, 3, a swing formation. And that third candle is showing you a willingness to continue to the downside. How do you know it's willing? Think about this. This candle's closed and this candle's open. Pay attention to here because I'm going to flip to a line chart. So look at this tiny V here. I don't know if you can see it. Yeah. Then this guy pushes all the way down. So that's something for you I don't think I mentioned before. Anyway, you have your swing. This is your swing high. Now all we're waiting for is, okay, when is the market going to pause and turn around? And then it does what? Pushes down, 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 and now you have that 1, 2, 3 swing formation. This candle here would be the one that shows you the proper willingness to push. So now I've seen my swing low here. So from that swing down to this swing, and I pull it back. And now, remember, all of this other stuff hasn't happened yet. But now I have room to play. And I can ask myself, okay, the market has pushed all the way up into this portion of the swing. Does it make sense for me as a positive risk reward trader to say, I'm going to have my stop loss here for 49 pips and my take profit here for 32 pips? Or does it make more sense for me to say, you know what, I'm going to have my stop loss for 32 and my take profit for 49 or 50, which is slightly. Are you starting to get the picture? So that's basically how you start to think about ranges. Now let's go back to the monthly chart where my notes are. So I've told you you can use a single bar, and I've told you can go from swing to swing. And by the way, for those of you wondering what a swing would look like on a range bar chart, just give it a moment, it needs to populate. Per usual, it's going to take time. So this is one of the reasons I love me a range bar chart, because typically the swings, they're almost always trustworthy. They're pretty clear. 1, 2, 3. Okay? Look at another one here. 1, 2, 3. So even if 1, 2, 3, and all you did was say, okay, 1, 2, 3, I'm now looking to short and have my stop loss above the swing. And then you now know you have a defined point and you're like, okay, cool. But that's not what I'm trying to show you here. Okay? Let's take a look how you define ranges. Here is the same thing. 1, 2, 3, this is a swing low, pushes up. 1, 2, 3, you have a swing high. So now, what do I have? I have my range here, and then I have my high over here. And then the market keeps going. And then I could ask myself, as it's starting to approach really close here, do I want to maybe take a chance? Since this is a 50 pip range bar chart and each bar is worth 50 pips, do I want to take a chance as we start to approach this area and maybe say, you know what, let me get a buy-in, even if you don't see this fully formed and it's like around here. Let me get a buy-in because there's like 60 or 57 pips to the downside, but to the upside is almost 100 pips. Are you starting to understand? Okay, that's one way to think of ranges. Same over here. 1, 2, 3, that's a swing high. Okay? Now, very obviously, this is a swing low. But you're not about to start marking this. You're on a 50 pip range bar chart. What the fuck do you want to do? By the time this is confirmed as a swing low, this guy is closed down here. You're a 50 pip range bar chart. Remember that. So much better, you wait. The market starts to push lower, lower, lower still, and then finally gives you this swing here, making this your new low. And now this means all of this is your range to play with. And then you're watching the market. It's starting to push up. And you're thinking to yourself, okay, well, then let's start again. So the market has formed a swing here, right? Where you are right now, you're not quite at the halfway point, and it feels almost like you could be a buyer, okay? Maybe this is 100 pips or so, and up to the upside is like 110. You very well might have decided to buy, and you may have gotten something if you're the kind of person who moves your stop loss to break even and takes something off the table when the market pushes significantly in your favor. But as the market starts to approach this top side of the range here, you might start thinking to yourself, while that buy is running and while I've taken some profits from there, I have a unique opportunity to sell. May it work out? I don't know. I'm not sure. I'm in the business of probability. And I'm not about to lie to myself and say I know exactly when it's going to turn around. So, what I do know is that from this point where we are now, where this new bar has closed, I do know that to the top of the range is just about 56 or 60 pips. And that from there to the bottom of the range is actually 100 and something pips. So what makes sense? It would make sense to try for that sell. And then you can see, so what I'm doing now is I'm creating some wiggle room in your brain, because now at the beginning I was telling you that buying and selling randomly does not make sense. But now I'm telling you that when you have a premise for doing both things at the same time, then it makes sense. Because remember the condition here, you were close to this point here, it would have been pretty much a one-to-one trade. I'm assuming that you're like me and you're taking profits when you've gone significantly, at least halfway. This is about 50 something pips. You should have collected something by this point. And then you have your stop loss at break even, so you don't care. So you're done with that trade, even if it's still running. But you do have another opportunity presented to you. Will it work out? You don't know. You have to be okay with not knowing. It's fine. That is life. In real life, nobody knows shit. We could wake up tomorrow, all the people bragging about Africa being safe from tsunamis and natural disasters. I keep begging you guys to shut up, because one day, you don't know. You never know. Okay? So You just know you have, if this plays out in your favor, that it's going to favor you. So here you are, you take that sell, and then you're in it and you're running. And even if you wanted to say, okay, I'm just going to get out when I have an opposite closing candle, that's fine. Or if you wanted to get out at the end of the range, okay. Or if you want to get out like halfway, let's see, what is this, 60 pips, and then you find, oh, we're at 1 to 1. We're approaching 1 to 2 or whatever. Okay, good, I'm out. So, spoken a lot. Let's take us back to our notes. All of this, I promise you, still involves liquidity, and we'll get to it. So I've talked about liquidity being money. I've said that your job as a trader is to ask yourself 3 questions. Where's the money coming from? Where's the money going to? Is there enough room between these 2 places to take some for yourself? I've told you that to answer this question, you must create your range. We've defined a range as the area between 2 price points, regardless of whether it's just 1 pip or 1,000 pips. And I've said you need that range for you to have enough room to take pips for yourself. You need a high time frame or a high range frame to create your range. And I said for how to create your range, you need, or you can use a single bar, or you can go from swing to swing. And I said, what is a swing? A swing is a turning point in price. I've shown you a swing on a regular candlestick. I've shown you a swing on the range chart, and a swing also absolutely exists on a Renko chart. Look at it. All right. That's a lot. This is a 10 pip Renko bar chart, but it's right there. This is a swing, this is a swing, this is a swing. And I need you to remember, when it comes to Renkos, those of you who decide you want to work with Renkos, remember, just because you have this does not mean this is the high of the swing. The high of the swing may be further up here, but it does not show because it's a Renko bar chart. Same thing, this is a swing. The low may be lower down here. Okay? So the same swings exist everywhere. Just keep it in context. Now, once you've defined your ranges, the next thing you need to do is figure out where the money is relative to the range. So let's type that. After defining your range, you have to figure out where the money is relative to your range. For those of you not interested in this part, I've already told you how to use a range to your advantage. But for this, you must know the different kinds of liquidity that exist. So primarily there's 2 kinds. Number 1, you have external range liquidity, which is money outside the range. And then you have internal range liquidity, or money inside the range. So for external range liquidity, there are basically 2 areas. Okay, those of you familiar with ICT, I'm going to simplify your life now. Let's forget about intermediate swing highs, intermediate swing lows, forget about intermediates and long terms, whatever. It is just you have external liquidity at the high, at the low. Yes, there is some usefulness for getting into all of that detail, but again, this is about simplifying, guys, because things are too subjective when it comes to price. So it is just so much easier to have a simple definition. Give me a moment. I need to prove to TikTok that I am alive and I am actually talking to you guys. But while that's occurring, I need to slide this. Come on, you guys, give it to me. All right, here we go. Slide that into place. All right, so as I was saying, the 2 kinds of internal range liquidity are, and there's actually more than 2, all right? Hang on, guys. TikTok is really being annoying right now. I am here. Gracias. Okay. All right. Much better. So, 2 kinds of internal range liquidity. We have, number 1, order blocks, which can be bullish or bearish, and number 2, fair value gaps, which can be bullish or bearish. And I know that if you're familiar with ICT, you're talking about 50 million other kinds of internal range liquidity. We don't do that here. My whole point is simplifying. I want you to be able to spot 1 or 2 things and to spot them with so much confidence and be able to trade with them with enough confidence that you make money. Because if you're able to recognize too much, it can be very confusing. You don't need that. You don't need that at all. So let's talk about what an order block is. So this is the monthly chart in Euro USD. Look at this. the market has been pushing down. And then finally, it's probably not the best example to use, but I need you to keep in mind it's a monthly chart. So if you're getting a break, a candle that is breaking and closing above a monthly chart, a monthly candle, okay, that's 2 months away. That's pretty significant. And look at how much it pushed. It matters. The last candle, the last bearish candle that led to the break of that high becomes an order block. I'm going to have to drop down to a different example because what I've just said here is going to confuse some of you. So I'll show you. Look here. This is a 30-minute chart now, I believe. Yeah. So look at this. Look at this low here. It gets broken. The last bullish candle that led to the move that broke the low is your order block. Let me grab this and mark that. Change the color here to white and make it transparent. Awesome sauce. Right. The whole idea behind an order block is this. Let me zoom in so we can see this. Zoom in. So this is the idea behind an order block, right? The big players in the market, the hedge funds, the central banks, the people who purchase currencies in amounts that we can only dream of, they cannot just enter into a trade at once, because if they do that, if they try to just sell all at once, you're going to have this long bearish candle. Everyone all over the world is going to be like sell, 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 and everybody's going to like, somebody has to lose to make money. So they're not trying to take you along for the ride. So what they do instead is they've got this push down, they've broken this low here. Great. So they've got some orders in here already, and that's why you have this move to the downside. But then what? They buy it back up again and come back into this. This is called an order block because this range here, notice an order block is also a range. This range of prices here is where they have primed the rest of their orders to be placed. And so they put it back in there, the rest of it, and then they start to take off. Okay? That's why it's called an order block. This range of prices, they don't really care for accuracy per se because they have the money to move things, all right? So it's just like, okay, yeah, get us filled in here again, and then we take off. So that is a bearish order block. Let's show you a bullish example. See if I can find one. So 30-minute, I should probably drop to... actually, yeah, beautiful. So I'm taking you to GBP USD. And this is our 15-minute chart today, or rather yesterday, because it is now midnight my time. So this is an example of an order block, bullish style. First things first, let's zoom in. First things first, what do you notice? You have this move that pushes and breaks this high over here. The moment that break occurs, the last bearish candle, let me move this so you can see it. The last bearish candle that sponsored the move that led to this push to the upside, that is what? That is your your bullish order block. Okay? Again, same principle. They want to take things to the top side. They're not going to put all of their orders in at once. So what are they going to do? You first put some in there, and that sends that rallying a bit. And then they come back in. Notice in this example, they didn't go all the way in. They just needed to tap it just once, and then they took off. So how would you trade this? It's simple. When you see that order block set up, you can have a pending order here and your stop loss below the low of that. Same thing with the other scenario. When you see the bearish one, let's see if I still have that on the chart here. What was that? Yeah, same thing here for the Euro USD setup. You have this, you put a pending order here. The market comes back, taps you in, your stop loss is above there, and then you're looking to take profit. And I hope you're also noticing that even as the order block is a range, okay, in this situation, you had this swing forming, and the market came and formed another swing and showed that willingness to push up. So the question is, why is it called internal range liquidity? Because this order block is inside of the range from here all the way down to here. All right? So those are order blocks. Now, what is a fair value gap? Let's find a good example that's beginner friendly. Give me a second. There we go. All right, cool. So I'm gonna grab another rectangle here. Come here, please. Gracias. Bring this down. So for the fair value gap, you are looking for, I need to make this, yeah, it's a lot of movement. You have this low, okay? 1, 2, 3 swing low. What happens? This market breaks that low with a strong close. Look at it, closes below the low. Not a wick, a close. Especially because you're in a lower time frame, you need that close. If it was a high time frame and the market only wicked through it, I might consider that as a break because again, the high time frame is significant and that wick on that high time frame on a slightly lower time frame would actually be a full-on close. All right, but in this case, this is just the 30-minute chart. What do we have here? We have a break with the close. Then the next 30 minutes, we're waiting to see what happens. This candle, once it closes at this point here, we notice that, I'm going to stretch this so you can see better. From this candle's low, which is the candle before, so look at this guy that broke this area here, the candle before it, we're going to pay attention to the low. And then the candle after it, we're paying attention to the high point. So now I'm dragging all of this back. And I want you to notice that between these three candles, this area here was nothing but body, nothing but sell. There's no wick from here. There's no wick from here. This area here is an imbalance. Why is it an imbalance? Because sellers got to have all the fun. Buyers couldn't do shit around here. And we need to rebalance things before we can continue our movement. So this, as soon as this candle closes here, this gap is formed. And then this has to be rebalanced, which is why this closed here, the market retraces into this gap, only pulls up for just a little bit before it starts to reject it downwards. This gap here is called a fair value gap because since only sellers had all the fun here, the market must return back into it to offer fair value to the buyers as well, so that there is equal exchange, sort of. Now, sometimes with a fair value gap, sometimes it will not retrace this far. It might just be like a little, tiny little pip retracement before it starts to drop. So that's something to keep in mind, especially if you're using higher time frames and you're a scalper. And then sometimes when it does that tiny little pip and then dropping, later on it may come back again and then form another swing and go down. But me personally, I prefer fair value gaps that have been touched exactly once. I'm not interested in the second touch, but that's me. That's just my thing. It doesn't mean that it wouldn't work for you. That's my preference. So this is a bearish fair value gap. And notice how, once more, it is a range of prices. So the market could have just tapped into here and dropped, or it could have pushed all the way up above it, then turned around and dropped. And we're going to talk about that in a second. So those are the two kinds of internal liquidity. We've talked about, I've shown you a bearish example of a fair value gap. Let's look for a bullish example, and then I'll go back to external liquidity. So let's look for a bullish example. Let's see, what have we got here? Awesome sauce. So this, you have a high. This candle breaks that high. Strong close above it. We're waiting. What's this candle going to do? Then it closes here. As soon as it does that, it's left behind what? A fair value gap. Why? If you were listening and paying close attention, let me change the colors on here. Give me a sec. We're looking at the wick of this candle and the high of this candle and the low of that candle. So let me drag this up to the low and drag this back down to the high. So same story. What do we have here? The market broke this strongly and then left, after closing this, it left behind this gap, which is an imbalance called a fair value gap. So what happens? The market makes a swing, okay? It makes a swing and then it starts to push to the downside. Now this is a 30-minute chart. It pushes to the downside and it taps by just a tiny bit, not even up to, is it up to a pip? That's like 0.5, so like literally 5 points. And then it rallies. This is that thing I was saying where sometimes it won't hover around too much, it won't go too deep, it'll just tap and take off. I need you to pay attention to something that I just pointed out again that you may have missed. I said that once the fair value gap was formed, then you had a 1, 2, 3 swing. What did we say this is? What did we say a swing is? It's the turning points in price. This is a 30-minute chart, I will grant you that. But imagine that you spot something like this on a daily chart and you have not yet touched this fair value gap. So now you can start to think of this fair value gap here as a magnet for the price, which means, let's say this is a daily chart. This bar closes here. You start to look for reasons to sell into that. And this one, on this 30-minute chart, it just gives you 6.7 pips. But on a daily chart, it could be massive enough for you to get something. So maybe you're just looking to take that and get out. All right? Alternatively, you could just be like, yeah, I'm going to ignore that little retracement, which again, retracements, so this is an uptrend, obviously. On a daily chart, a retracement would be much more significant for you if you are a day trader or a scalper because it'll offer enough pips. So let's not just bounce about it. Let's see if we can find that shit. This is an example here. We have what? Not only do we have an order block, we also have a fair value gap. And there's something that I want to say that I've not said for this particular live, which is when you have a fair value gap that is right along with an order block, it's telling you that order block, which is this bearish candle here, is high probability, meaning it has a high chance of playing out. High probability, not high certainty. There's a difference between those two words. Probability and certainty are not the same thing. So let's look at this. Let's say I was only focusing on the fair value gap. Okay, no problem. Then what happens? The market pushed up and then it did this. 1, 2, 3. That is a swing. Remember, this is a daily chart, so the swing would be significant. Now, I will grant you that the market opened below here and then it started to push up again, but still, we could have been looking either below here or from here for a reason to sell because we know that this fair value gap is acting as a magnet for price. Okay, which is what we refer to as a draw on liquidity. What does it mean to draw? To pull something close. So you know already. So if you wanted to, now we have this 1, 2, 3 swing formation. Let's say you found a reason, something in here on a 15-minute time frame as a reason to exploit. Okay, or even if you waited for this bar to close, let's see what we have here. A bit of pullback and then what? It drops about 81 pips or it's slightly over 81 pips. That would have been something. And then as you're dropping into the fair value gap, because you are now pretty smart and hip to things, you have taken some profits or you've closed the entire trade. That's up to you. But if you've taken some profits because you wonder if this fair value gap is actually going to hold, because again, nothing is 100% all the time. Nothing works 100% of the time. But while that sell trade is in play, you've taken something off the table, you can forget about that trade and start looking for, okay, is there a reason for me to be a buyer? And then if you're buying, whether it's based off of the fair value gap like so, or based off of this order block, look at the high of the order block it gets tapped into. The next logical place to take your money is at this high. So that would be what you'd be targeting. All right, so I'm going to quickly go to a point I have not yet addressed, which is talking about external range and internal range liquidity. I have shown you how to trade from internal range to outside the range. So I keep saying there are two kinds of traders, right? Two kinds of traders. You have to know which one you are. You can do both things. I'm not saying you are incapable, but I'm saying your life would be so much simpler if you picked one. So number one, you could be the kind of trader who takes money outside the range. No, takes money from outside the range to inside the range. Or the kind of trader who takes money from inside to outside the range. So let me drag this off to the side. I've shown you what internal range liquidity is. Again, why is this fair value gap seen as internal range? Because think about it. We have this low here. The market pushed up and made a swing. Now you have a range from this point all the way up to that point. The liquidity or the money is inside that range. Okay? So look over here as well. Same deal. Why is this one here? Hang on a sec. Why is this order block here seen as internal range liquidity? The market made this high. pushed all the way down, and then we started to have this turn back up. This is the range from this point to this point. The order block is inside of the range. So when we talk about external range liquidity now, we're talking about highs and lows, okay? Highs and lows, very simply, of the range. So what's an example? Let's look at, let's see, what have I got here? Best example I could think of for now is that EuroCAD one for 100 pips. I'm taking you to the 100 pip range bar chart. Please be patient with me. All right, we need to wait for that to load. And while I'm waiting, let's see if I can get this to charge because we're running out. Give me a second. And boom, awesome. Get that to balance. Great. So, was it this one? Was it yesterday? When was this? The first, actually. Yes, it's accurate. I think it was this. So, this is the 100 pip range bar chart, which basically means you are looking at each bar being worth 100 pips of price action. If you are an external to internal range liquidity trader, and permit me for just randomly picking one, my time is almost up, so I'm kind of trying to wrap this up as soon as possible. If you're doing external to internal range liquidity, what can you do? So let's say this bar here that I have marked, that's our high and our low, right? I'm going to go down to the 1 hour chart and see about that. Remember, what I marked out was a bullish candle. This is the moment here that 100 pip range formed. So I could very simply either wait. Let me zoom in so it's closer and you can see it better. This is a 1 hour chart, okay? So we have the market pushing up, pulling back, pushing up, pulling back. If I switch to a line chart so you can see, this is a low here, it gets broken. So I'm showing you another example of how to view things. This low gets broken. And then when the market starts to turn around, what do you have? From this point to this point is what? A range. Now, something I've forgotten to say, which I should share now. There are 3 significant parts of a range you must know. Let's grab my notes. I will have to add that somewhere else. Give me a second. Changing this to 16 and change it to bold. All right. Number 1, you have equilibrium. Number 2, premium. And number 3, discount. Okay? So, first things first, I'm going to zoom in even further on this. Let me grab another rectangle. Change that color. Please make it transparent. Thank you. So, notice, this is the low, this is the high. With a line chart, the line chart uses just closes. Okay, that's why you're seeing that there. I'm going to zoom out again so you can see it better. Help. There we go. So the 50% portion of the range is called equilibrium. Equilibrium is a word that means balance. When you say things are at an equilibrium, it means that there's a balance of things. It's not bad, it's not good, it's okay. There's an agreement between buyers and sellers, or at least there's an agreement in the market of what's a fair price for buyers and sellers, right? So anything could happen at any point from equilibrium. Anything that is above 50% is called a premium. And the whole idea of a premium is you want to be a seller when the price is in the premium portion of a range. Only when, number 1, you are in a bearish trend, or number 2, you have ascertained based on a high time frame that you are in a bearish retracement. Even if it's a bullish trend, it's a bearish retracement. Remember, we said if it's a daily chart, if it's a weekly chart, whatever, we know there's more than enough pips in a retracement for you to take advantage of if you are a day trader. So for a position trader or as a swing trader, that might not be enough for them. But as a day trader, as a scalper, that is more than enough. 50 to 70 pips, that's more than enough, right? So those are the conditions in which you sell from premium. Or number 3, if you have decided, I haven't said this one before, if you have decided that you're going to look at your high range frames, I said range for a reason, not time, your high range frames, and you are deliberately going to be a counter trend trader. It just means if you are also going against the trend there, be quick about taking your profits. So if you're getting into a sell from premium, as you approach equilibrium, start to lock shit in. Take something off the table. You can then exit your position fully as you approach discount. The discount portion is everything from beneath 50%. What do you do at the discounts? It's the reverse. You want to be a buyer there. So what does that mean? If you're already selling, you closing your trade is pretty much the same thing as buying, if that makes sense. Buying and collecting your money. Vice versa, if you were buying from discount and then you're approaching premium, you can close there. Now, why would I suggest that sometimes? Because sometimes the market will not go all the way to the other side of the range. And if you want high probability trades that tend to hit your take profit more often, don't get greedy. As you start to go just below that equilibrium, you can take your trades off the table, or at least take something. All right? So in this particular instance, remember we came from the 100 pip range bar chart. That's this white square that's underneath here. And remember what we're looking at now is the 1 hour chart. We have this low, and this low gets broken. So now as it's getting broken, what do you have? The market is retracing again into another range. So if you missed this formation here and then a reason to be a seller at just above 50% for this, look, another range here from this high to this low. And this is a line chart, for those of you wondering. What do we have? Equilibrium. Just above equilibrium, you could be a seller. Your stop loss could be above here or here. Let's go back to a line chart, regular charts rather. So this is what we're looking at. Or you could have gone down to a lower time frame because you're looking for some clever reason to be a seller. Let's see what that looked like over here. This is a 15-minute chart now. So you could have just said, okay, we've pushed above here, we've pulled back, I'm waiting for this low to break. Let me get this out of the way. All right, so now I'm waiting for this low to break. This low gets broken. Once it gets broken, what does it leave behind? Fair value gap and what? Order block. Let me zoom in. I'm pretty sure it's not that clear. Hold on. All right, so here, this low broken leaves behind a fair value gap and then this order block here. I'm sorry, guys. I don't know what's up with the camera today. It's not as clear, and I've cleaned it. I've adjusted things, but whatever. So here we are. Your stop loss could be here, or it could be above that high here. If you kept it here, you'd have been taken out, but no problem, because you still understand the premise of the trade. And even then, what do you have? This low gets broken. Once it's broken, this automatically becomes an order block, this white candle here. This guy. And then the market retraces back into it and does not break that high, and you're off and running. And then remember that this is framed on the idea that you're expecting 100 pips. So maybe not a full 100 pips, but like at the very least, this is a 100 pip range bar chart. You remember that's what we framed this idea on. So the whole idea is, surely out of that 100, it's okay to take maybe 50 to 80. You don't need the full thing. And if you think, oh, that doesn't work anywhere else, you could do it with each. I don't care what you use. You could use this guy. Oh, but it looks weird because look, they traded above it. It doesn't matter. Let me show you. So this is you if you decide that you are an external liquidity to internal liquidity trader. I've shown you one example. I'll show you another one again. So we've marked the high to this low, and you want to be a contrarian, no problem. You're looking at it as this is the range. If we're trading outside the range now, I'm looking for reasons to go back in the range. Okay then, well, let's go find out. Let's drop down to the 1 hour chart again. What do we have here? So this is that 100 pip move once more. And all you're saying is, okay, I'm going to wait for this low to break. What happens? The market retraces. It does not break the low. It honors this order block here and bounces from it. If you were feeling adventurous, you could have said, okay, fine, I'm going to take that again and just wait. If you weren't and you're only interested in your sell, that's fine. What do we have here? This low, this low, this low. This gets broken. This gets broken. This is another thing I want to tell you. If you don't care for order blocks and you don't care for fair value gaps because you find them confusing, when you pair liquidity anyway, you can simply use the break as a signal. Okay, cool, I got that break. Now let me have my stop loss all the way. That's the only thing about not using order blocks and fair value gaps. You're looking at the break and you're saying to yourself, okay, great, I'm taking that break itself, but I'm going to have my stop loss way above the high here because we don't know how far it's going to retrace, right? And then if your stop's here for about 30 pips, the market pushes down for 40 something pips. That's up to you. Alternatively, you use what it is I've just taught you, which is if this broke, this is now an order block. So let me mark that. This last bullish candle here. This last bullish candle that led to the move that broke things is now an order block. And oh yeah, but it traded past it. Yes, it did, but did it trade past this swing? Let's not forget. What is a swing? A turning point in price. If the swing is not getting broken, then it's still valid. And now, remember the thing about ranges. If you didn't want to take, the risk of trying to wait for 100 plus pips, doesn't matter because now you have a range from this point to this point here. And what did I say? This is the halfway point. This is premium. This is discount. You're looking for a reason to sell here. You found that reason. You have a pending order here. You're in it. Your stop loss is at the high. The market starts to turn around. Again, this is the halfway point from this point to this point here. So now what? What did I say? Either start taking your profits at the halfway point or you wait for it to start trading into discount and then you close that trade. And that's something. And in this case, if you use the order block, your stop loss would have been about maybe 17 pips. And you're taking about 42 or something pips or 45 pips from that point here. Actually 50. So that's pretty much it for external to internal. For internal to external, your case, let's take a look at a couple of examples so you can understand. Your thing is you're looking within, give me a second. So let me say something. I don't think I've said this like this before. If you are a scalper and the market has moved 50, 100 pips or created two bars like this, even if, I'll grant you, there's been all of this movement here, okay, all of this downward movement, you're probably wondering, why am I ignoring that trend? The reason I do that is because typically my trades are actually scalps. I need you to understand if you're a scalper who's gunning for 2 pips, 5 pips, whatever, 2 to 5 pips, maybe 10, 12, a 50 pip range bar chart is actually pretty significant. It is significant because I'm only looking for just a tiny chunk of that. So if I have 2 bars closing, I will definitely be looking at, okay, there's a chance I may be able to take something for myself. If you are a swing trader, okay, then you go to a 100 pip range bar chart. This is an example. There'll be something for you there. So it's relative. What I'm trying to say essentially is I could literally just look at a single, so this is 50 pips, right? This is a 50 pip range bar chart. I'm going to quickly go to a 200. Just bear with me. Give me a sec. I could look at it and I could say, because I don't want to stress myself, this is a 200 pip movement from this low to the high. Surely 200 pips is significant enough for me to say to myself, you know what? I'm only looking for buys. Or in this case, what do we have here? This was a 200 pip movement. And yes, it closed bearish. But before it did, it gave you something. And even if you see this as, okay, 200 pips bearish, if I'm looking for a reason to sell here, maybe I lose a couple of trades. That's fine. That's fine. But eventually, like, it's crazy. I don't know how to explain this. If you also look at this, think of the fact that on a typical chart and even on a range bar chart, if you are noticing that the lows of each candle are not being broken, remember we've talked about this multiple times in previous lives. We've talked about lows not getting broken. You're noticing this is getting respected. It just tells you, okay, maybe try to just be a buyer. And then let me put you on game. How I'm able to catch stuff like this sometimes is because when I see this, yes, it looks like that. It looks like it's bearish, or look at that wick. But I'm thinking about the fact that it didn't break this low. So I'm offering myself the grace of this distance, from this distance here to that low, and saying, I'm looking for a reason to be a buyer anyway. So that's like a shortcut. For those of you who don't want to bother with looking at high time frames or whatever, you could pick a single high range frame bar. However, make peace with the fact that you must wait on the lower time frames for something, whether it's that internal range liquidity, an order block, a fair value gap, something that you can take a trade off of. Okay? So if you don't see it, I prefer, if you're going to do this, make sure that you have an order block that is also followed by a fair value gap. Because what did I say? The fair value gap tells you that order block is a high probability order block. All right? So let's come back to the examples for those who will be trading from internal range liquidity to external. So look at this example here. I've marked this low to this high. What I'm going to do now is go down to the 15-minute chart and see what I can find. So this is that moment that the range bar closed. All I'm asking myself is, what is below 50%? What can I see? This is a high. Zoom in. This is a high that got broken. Immediately it got broken. What did this become? An order block. So all I'm doing, so this is where the price is at that point in time. I must wait for the price to retrace into here. So I could have my pending order here, my stop loss below the swing, and then I'm looking to take it where? I'm teaching who now? I'm teaching the internal to external range liquidity trader. So I'm willing to take this trade from inside the range back outside the range. Make sense? Notice how it gave you multiple opportunities. Multiple. And then I need you to notice the fractal nature of price. Those of you who are external range liquidity traders who take money from outside to inside, you can also very well view it like this. So while others are looking at the order block, you're looking at this as a range. Why? Because we have this low that pushed up and then here. You're looking at this as a low to be rated, the low of a range, which gets rated. And then on the lower time frame or this one, you get a swing formation indication it wants to keep going up and you can continue. You see how it's just two different ways to look at the market. Look at it again. You have another low here. I actually went too far. You have this low here. It gets rated. 1, 2, 3 swing formation. What's a swing? A turning point in price. We have another bar that tells you, okay, there's willingness for it to continue pushing up. Okay, great. Your stop loss here. Let's see if this turning point is going to be respected. Look here again. We push down. What are we rating? These lows over here. We push down in this one. This was news. You would have missed it. There's no way you'd have gotten it, I don't think. But this is a low that gets rated again. And all of this is within still the same example I'm showing for the other kind of trader who's looking for internal liquidity, like money inside to take outside. Let's look at another example, the following one. Hang on a sec while it repopulates. I think we would have missed this because this was a news thing. Let me look for maybe CAD-yen. How about that? Let's see. Let's check out CAD-yen. And then we'll be closing in a few minutes after this one. I just wanted to do something for those who trade from internal to external. So just pick one, guys. Hang on. This is a range bar chart, so it needs time. Let's see. Did you pull up into 50? Almost, but not quite. But I'm almost out of time, so I have to... Excuse me. The concept still remains pretty much the same. Change that color. All right. So all I've done now is I've marked the low and the high of this bar. Okay? Now I'm going to take us down to the 15-minute chart to see if we could have found anything. So this is an interesting one. This is the moment that that bearish bar formed. 50% of it here. Because I know when I see this pattern, first of all, you can see there's a tiny fair value gap. And I know this is not a bullish candle here, but if I go down to a lower time frame, you'll find it's an order block. So let's go down to the 5 minute. Because price is fractal. Here we go. This low here. This is the 50% point. What's at 50%? This low got broken. Once it got broken, this became an order block. That's too stretched out, girl. Calm down. Once this low got broken by this candle here with a close, this candle became an order block. So the market retraced into it, respected it, just tapped into it, okay? And then took off from there, running. So that's one example. Let me look for another one, see if I can find it on maybe a somewhat smaller range frame for scalpers. So let's go for the 10 pip range bar chart. I should definitely find a few examples here. Excelente. Lovely. All right. What is... my broker is doing a weird thing, guys. Give me a sec. Yeah, my network's fine. Okay. Come on, come on, come on, come on. Okay, we're done. So let's go down to a 10 pip range bar chart. Where are we? Let's get that again. Boom. What time is this? That's going to be a shitty example because it's near market close. Right, I'm going to delete this, and now let me grab a rectangle and show you here. What time was this? I hope it's not near market close. That would have sucked. What time is this? What time is this? All right, what time is this? So the reason I'm avoiding market close, guys, I do not trade then. Your spreads get wider. And I have a really good broker that does not widen the spreads all that much, but it still sucks when that happens. Excuse me while I change this color. And make it easier to see. Okay, so here we are. Look at this. Marking the high and the low. Assume for me for a moment that this has not played out yet. This is a 10 pip range bar chart, which means each of these are worth 10 pips. So this would be more interesting to you if you are a scalper. Okay? Now, but I do want to say, very, very strong caveat. If you're going down to low range bar charts like this, please don't just go straight to a range bar chart. I need you to come and check on your regular time frame chart if there's any reason to anticipate you should be taking that trade. So let's go to the 1 hour. We'll be looking for like a magnet in price or something. Let's go to the daily. How would I show you that now? It's really messy, but if you're observing, if the market is pulling down dramatically like this all happened in a day, it just becomes obvious that at least you may be looking to target something inside of or around here to sweep these lows. But now let's go back to the 10 pip I've shown you. So now I'm going back to the 1 minute to show you exactly how you would have traded with that. I don't know what's up with my broker, guys. What's going on? Okay, there we go. Here it is. This is that range, that 10 pip range. What's at 50% just above it? Notice we had this low. It got broken. This is the last bullish candle before that. What does the market do? It retraces into that candle, respects it wonderfully well, and then drops. This is for you people who scalp. So if I were a scalper, I'd first look for a reason to be sure that, okay, I want to get into sales, which could be like maybe H4 fair value gap, something on there. So like here, what do we have? This is another fair value gap. And this is H4 on the CAD yen. So I could just say to myself, I need to get a clear sign the market wants to turn around from there. This is that fair value gap. The market retraces into it like this. And if you were there on the live on Friday, I spoke to, oh my God, was it Big Baby? I think it was Big Tobias. And I told him, I said, how do you know to start getting into or getting out of a trade? Let's say you were in this buy here. How do you know that you should get out of the buy? If you start to see fair value gaps forming in a direction against you. So this, it would count. Why? Because we're coming from a 4-hour chart fair value gap, bearish fair value gap. Don't forget. Let me change this. Don't forget, it's a 4-hour bearish fair value gap, and that 4-hour is going to be powerful, that it doesn't matter what's happening on this 15-minute chart, the 15-minute chart must obey, or is more likely to, has a high probability of obeying, I should say. So it doesn't matter, oh, we had this, yes, the market tapped in, yes, it pushed up to here, but now you're getting this. When this candle closes, you have this gap here. That should tell you, if I'm still in this buy, at least let me move my stop loss to break even, and what happens? But you're not interested in a buy in the first place because you looked at the 4-hour. So once you've seen this fair value gap form, I'll put a horizontal line, or rather a vertical line here. You've seen the fair value gap form. So from this point on, you can start saying to yourself, now I'm going to start looking for breaks in structure to the downside. Now I'm going to start looking for it. You could keep it as simple as I just want to see a break in structure to the downside. What do we have here? A low. Now, if there's a wick to the downside, I would take it seriously now, even if it's a 1 minute chart. Why? Because I have gotten all my ducks lined up in a row from the 4 hour down to the 15 minute. So there's a 4 hour fair value gap that's bearish. Then I waited for the 15 minute time frame to also line up by giving me its own bearish fair value gap. And now if I come to the 1 minute, I can confidently say, okay, if I'm seeing fair value gap bearish, I take it. I don't care. So you had one, if you're using just fair value gaps, you had one opportunity. You have another one here. Let me zoom in closer so you can see. And I'm also going to delete the square. This is a fair value gap. The market breaks the slow, another fair value gap for another sell. This is, so you get it. This is the importance of finding a reason from the higher time frame. All right, guys, I'm going to wrap it up here. Let me flip my camera around. Thank you for the likes. I see you. Thank you so much. Oh my God, 53.7. You guys have been really busy. Teach Flu, please help 5XRP. We don't do that here. Goodbye. Fogba, thank you for the live. 60s, thank you. Ola T, thank you so much. And Trix111, thank you for the follow. Hi, what's this concept? Liquidity. Abdul, thank you for the follow. Parkim Treya, thank you. I'm not even sure if you guys are still here, so I'm just going to scroll through and see if I missed any questions or anything. King Meek, the research docked. Thank you for the follow. I'm not sure why you're mentioning yourself, but okay. Which chart is this? Omo, I looked at Euro USD, GBP USD, and CAD Yen. So I'm not sure which charts you were referring to when I was talking about it. Forex, thanks for the follow. User with plenty numbers, thank you for the follow. Femi Coins, thanks for the follow. Blake676, thank you for the follow. Let's see if there's any. Kindly look at XAU USD. Do I think the FVG has been fully tapped or will it be tapped again? So, Sir Lord, like I said, when something has been tapped once for me, I don't touch it again, typically. You'll only catch me touching it if I see something on a lower time frame, like a break in structure, fair value gap, that is in line with that. But that's me. And that's signal adjacent, so I don't do that. Okay, it's 12:41, guys. I think I'm gonna wrap it up and call it a night. My phone is running out of battery. I've asked you, no problem. Freddie, hi, Coach JV, if you're still here. Freddie, I hope you got what you needed. You sounded like Sir Tony Tutorials. Well done. Well done. Very proud of you. If Freddie's still here, I hope that this helped you. Well, that's about it, people. So my name is Nessa. Also, I take tics on TikTok. I do these every night, 11 p.m. Not every night, sorry. It used to be every night, but now it's Mondays through Thursdays. We look at charts. On Fridays, we talk psychology. I do this 11 p.m. GMT +1, which is Nigerian time, West African time, which means we don't have daylight savings. So it's always 11 p.m. You can just make the conversion from wherever you are in the world. And if anybody's messaging you claiming to be me, it's not me. I will never DM you first. If you want to join the Telegram group, the link is in the bio. Just copy the link and paste it to your browser because for some reason, TikTok no longer allows people to open links in browser, or at least it affects some people. I don't know why. The YouTube channel was also linked to my bio. I think it should be there, but it's also I Take Tics if you're looking for it there. In the Telegram group, we talk, we share, we connect. I will never give you signals. I don't believe in giving you signals because that's me robbing you of a chance to be confident in your own ability to analyze a chart and make money for yourself. What I will do is point out things that you can see. And that's about it. Sir Lord, you're very welcome. Good night. So I'll be here again tomorrow. We'll talk. Please be safe in the markets. Be mindful of news releases. Be mindful of your risk. You don't need to do too much. If you've already made a significant amount of money this week, chill. You don't have to trade every day. And if you made losses, also chill. Tomorrow's a new day, a good day. Forget about yesterday. And those of you who've been making profits, where's my champagne? Anyway, I hope that something here has been helpful for you. 60s, you're very welcome. Gross 2024, you're very welcome. Ola TSCU, thank you. I will be here again tomorrow night. And I just want to say, may the pips be with you. May the markets favor you. And I will continue to see you as the master trader that you actually are until you finally recognize that for yourself. Have a wonderful day.